Have you done your research about cryptocurrencies yet? What do you think about technical analysis? Do you think it's effective or is it bogus? Stay tuned, because in this video, we will be covering technical analysis alone. Hi everyone, welcome to Crypto Intel. Believe it or not, there are people who believe in technical analysis effectiveness, and there are some who are skeptical about it. But in this video, we are going to dive deeper, knowing what technical analysis is, its usefulness, and the common patterns that you'll be able to notice for yourself. Before we go any further, don't forget to hit like, subscribe, and notify to get more updates from our channel and become more intelligent about the crypto world. Technical analysis is either overused or undervalued, depending on the people who perceive it and who use it. When it comes to investing in general, the rule of thumb is to make a profit by buying something at the cheapest price possible and then sell it at the most expensive price. While that's much easier said than done, technical analysis is a great tool to help make that possible. Just a disclaimer though, it's not a holy grail and it's not designed to make you wealthy overnight. Let's start! The first topic I want to cover is something that doesn't even have to do with charts or covering technical analysis. The most important question to ask yourself is who controls the markets? Now your first thought may be whales or institutions, or maybe even big market movers. The real answer is that the markets depend on us and the millions of other people participating in the market on a daily basis. Yep, all of us control the markets, and it's a known fact that people by nature are unpredictable, which also makes the markets unpredictable. There's a common misconception about technical analysis, and many believe that if you can just find the right tool or the right trading plan, then you can predict the future and make millions. But the truth is, nobody knows the future. The goal with technical analysis is to find a plan that works for you. Define your personal edge in the market and never let your emotions get the best of you. It is simply a tool to help you. Now that we've discussed the theory, let's break down the three phases of the market. We have an uptrend, a downtrend, and consolidation, which is a sideways movement. An uptrend is a series of higher highs and higher lows. As you follow the arrows, it looks like the market is going higher, but we know the market can't only go up, there needs to be retracements in it. A downtrend is the same thing, but in the opposite direction. You have a series of lower lows and lower highs, lower lows and lower highs. Simple. Last but not the least, a consolidation is when price gets stuck in between two price points and just continues to consolidate. We have Bitcoin on the 4-hour chart, starting all the way from the beginning of January, ending to around July 20. We have the market coming up, coming down, a series of higher highs and higher lows. Obviously, this is an uptrend until we start to make lower lows and lower highs in the market. Then eventually, right in this area, the market consolidates in between the price points at 36,000 and around 29,000. The market just starts to go sideways. As we go on even farther to the right side, we can see that the market starts to give us another uptrend until it starts to give us a downtrend. As you can see, the market just goes through these three phases over and over again. As you scale down to lower time frames, they start to happen more frequently. If you get to a higher time frame, it is a lot slower, but the price movements are a lot larger. We hope this really exemplifies how simple market structure can be and how easy trading can be sometimes, because there are just three directions the market goes: up, down, and sideways. Let's now look at what's happening within a certain asset that you're looking at. So, for example, we're looking at Bitcoin US dollar. Let's say we are looking at the weekly trend. Now, there's a couple really important things to know with trend lines. While they're very helpful and very simple, there's a couple of key things you need to understand about them. First is that they're very subjective, just like many other things when it comes to technical analysis. When you see a trend, it may not be very obvious or evident to other people, so always keep that in mind. The second thing that we need to understand is that a trend line needs to have two touches. For example, I have this trend line on the weekly that you can see the first touch is back around here, the second touch connects to right here, and the third one is where people are anticipating price to get to. The last thing we want to go over is that there are three main trend lines to look into. First is the macro trend. This is about where price is going on a very long time scale. For example, when we're looking at the weekly, the monthly, or the daily, you can see a lot of price action. This is currently around 658 days worth of data that we're looking into, so one can almost consider this as the macro trend. If we come down to shorter time frames like the 4-hour, 1-hour, or anything below that, that's when we're looking at minor trends. This is actually something that's happening right now. So we're starting this trend all the way back from November 10. And it's actually going to price action to where we are on December 30. Looking at Bitcoin's trend, we are currently in a minor downtrend. But if we were to take a look back at the weekly, you can tell that we are somewhat in a pretty bullish phase. So it's always good to consider what time frame you're on and what trend you're in on that time frame. The last thing you want to get into is a counter trend. The first thing we have to identify is what is our main trend. Again, looking at Bitcoin, we're looking at price action from the end of January, going all the way to around the middle of April. You could pretty easily tell that Bitcoin was in an uptrend just by looking at price and plotting this trend line right here. But a counter trend is the opposite trend against the bigger overall picture. Currently, we're in an uptrend, and the counter trend would be anytime price is going down against the main trend. This only happens for a little bit. After knowing what market structure is, the directions the market moves, and in what phases, it is also important to understand that the markets are fractal, which means it's a never-ending pattern. It's a mathematical phenomenon. It's basically just a self-similar pattern across different scales. The last but not the least we want to cover in this video are reversal zones and patterns. Okay, here's an example. We have the entire 2021 Bitcoin chart almost summarized for a lot of its massive uprises and downfalls. But as you can see back here in February, this massive uprising came from a lot of institutional support like Tesla, MicroStrategy, and MasterCard. They were all publicly supporting Bitcoin, which made it rise. Whenever a massive fundamental or news event hits the public, massive changes in the market happen. What we can actually do is we can map this out all the way across. We can use these as levels of future price reversal zones. You can see if we map these out, it's no coincidence that over and over again, when we see support or resistance right here. So while something big might happen once, it might not recreate itself in the future. Those levels will be remembered by the traders and investors in the future. That's all for this video. If you learned anything from our videos or have any crypto-related topic that you want us to cover, feel free to comment below. Don't forget to hit like, subscribe, and notify to get more updates from our channel and become more intelligent about the crypto world. See you in our next video!